You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is CEO and founder of the leading real estate crowdfunding website, RealCrowd.com, Adam Hooper. Now, Adam has worked on over 1 billion of real estate transactions with a wide spectrum of real estate professionals, sponsors, lenders, investors, developers, and institutional clients. His experience led him to conclude that current real estate practices are rife with inefficiencies and in need of a major technological overhaul. As the CEO of RealCrowd, he leads the day-to-day charge of growing the platform and ensuring its position as the premier solution in the industry. I'm super excited to get into the call and share it with you here. But before we do, I just have a few quick housekeeping items. Like I do each and every week, I always like to share with you one of my personal and professional bests of the prior week. And so I'll start with the personal best. So, due to this pandemic, we have not seen our in-laws, my wife's parents, for over a month now. And we actually got to see them for the very first time. They live close by, but my father-in-law, he's been unfortunately battling with a bad case of the shingles for the last few months, and his immune system was very compromised, and we just really didn't want to put him into any unnecessary danger. And so, over the last 6 weeks or so of this, quarantine, what have you, stay-at-home order, our family's been pretty much steering clear of much of the outside world, other than just normal shopping trips to the grocery store and things like that. And with my father-in-law starting to feel better, we all made the collective decision to have them over to our house for dinner this past week. And the boys absolutely loved seeing them. It was great catching up with them, and it was just really good to see him in much more positive spirits and just physically feeling a lot better than he had been for the last couple of months. And moving on to the professional best here, I just had the opportunity to spend the last couple of days in a video shoot, knocking out more than 40 real estate videos that ultimately will be releasing over the coming weeks. I covered a variety of topics, but a lot of it really revolved around commercial real estate investing, mobile home park investing, and we also did an entire 14 video segment on the parking sector, which you guys have probably been hearing me rant and rave about over the last few episodes, and we'll surely hear more about as time goes on because it's a sector that we're really excited about. I even got my 6-year-old Jackson to jump on a video with me when that was pretty cool. And so if you guys want to check out those videos, if you're not already following me on the different social media channels, you can find me on Facebook, LinkedIn, or at Instagram handle Bupp Kevin. So just my last name, first name, Bupp Kevin. Again, I'm on Facebook, LinkedIn, and Instagram. You can find the videos. I try to release at least one segment each day, sometimes more than that. And so be sure to check that out. And a few other things here before we get on to the call with Adam. Just want to remind you of the free 30-minute phone call that I offer each and every Friday. You can go to my website, kevinbupp.com, to get signed up. This is where you and I could jump on the phone for 30 minutes and talk about anything and everything your heart desires about real estate investing, whether you're brand new or a seasoned pro. It doesn't matter. I've talked to hundreds of you, probably thousands of you now over the last 5+ years that I've been doing this, and it's always an exciting phone call, and it's a way for me to give back and act as a sounding board to you as you move through your real estate investing journey. Again, go to my website, kevinbupp.com, to get signed up for that phone call with me. And now, guys, without further ado, I'd like to get on to the part of the show that you've been waiting for, which is our interview with Adam Hooper. So here we go. Alrighty, guys, it is my honor to introduce my guest for today's show, a real estate investment expert and founder and CEO of RealCrowd, Adam Hooper. Adam, how you doing today?
Doing great. I'm, adjusting to this new normal. So we're here at the house. I'm sharing a little bit of my happy place with everybody in the mountains here, and happy to be on today. Thanks for having me.
Yeah. For those that are listening to the audio version, he's got a pretty cool background, which is one of the Zoom features. He's got the, I don't know if it's a Rocky Mountain. It is a mountain range. We'll say that. And it's a very pretty backdrop there. So
the East Walker River up in the Sierra Nevadas. So
okay.
A very happy place to go fly fish if anybody's out there listening.
Good deal. Well, Adam, very excited to have you here. Obviously, we find ourselves in a very uncertain time, and a time that no one knows what ultimately is going to play out the following day. Right? We're kind of all on the edge of our seats, and we have been now for the past month and a half. And I don't know. You mentioned like get back to whatever that you mentioned. Made a comment there. Get my new normal, what have you. And I don't know if we even know what that new normal looks like. Today there is a normal, and then we're working from home and in a remote environment, and things have shifted a little bit. If you have kids, those kids are at home with you now; they're not in school, and just lots of changes. And it's going to be very interesting to see how these, the coming months, what that new real norm looks like. And I think it's going to take quite a bit of time till we actually get to that point to say, okay, well, we're back as a functioning society again, and this is ultimately what today looks like versus 2 quarters ago, 3 quarters ago, whatever that comparison timeline ends up being.
Yeah.
So, anyway, with that, what I'd love to do, Adam, and we're going to dive into the conversation about COVID-19 and ultimately what you're seeing on your side as far as any impacts it might be having to the crowdfunding space, also any specific sectors that you see might be doing better than others and what have you. So, but before we go there, what I'd love to do is for folks that aren't familiar with you, don't know about your background, maybe take a few minutes and just tell us a little bit more about who you are and ultimately what you did before you founded RealCrowd.
Yeah, thank you. So we started RealCrowd in 2013. We were one of the first handful of companies out there to launch this. And prior to that, my background, I've been in real estate since the early 2000s. Started out regional brokerage here in the Central Oregon market. Great start to the business of being able to do a little bit of everything: investment sales, leasing, land sales, tenant rep, pretty much everything. Small enough market that I got to really experience all the different sides of the brokerage pieces. And then just wanted to do bigger and larger deals. So started my own firm and with another partner, and we were focused more on single tenant net lease transactions around the country. And then saw a need for equity for preferred developers that were building, Walgreens or FedEx distribution centers. Tried to figure out how we can help them capitalize those projects, which got me into more of the kind of nuts and bolts of the capital markets side of the world. Did a lot of work in that joint venture equity structuring and equity placement there. Went down and joined a firm in Northern California in the Sacramento area, capital markets firm, and helped them build up a joint venture equity platform there as well on the brokerage side. And in working on just a ton of transactions, we saw a big gap in the sub-institutional size deals, right? So 15 to 30 million total capitalization. There's not a lot of institutional equity partners that will write checks to purchase those size deals, right? $2 to $12 million of equity. And so we had a few deals that we were working on that were $13, $14 million. And it was just this hand-to-hand combat of syndication, right? It's, you shut down the office, you do the road show, kiss the wife and kids goodbye, and you're out there just hand-to-hand combat trying to raise that capital. And so it was a combination of the efficiency that we couldn't really help solve that middle market syndicated equity piece. And this regulatory change with the Jobs Act, right? This was right around the time it was passed in April 2012. Through the middle and end of 2012, Kickstarter and Indiegogo and all these rewards-based crowdfunding, donation-based crowdfunding platforms were kicking up. And it seemed like there was a pretty interesting phenomenon going on there. And then we started digging into the Jobs Act and realizing that this new regulatory environment could allow that distribution mechanism to come to raising private equity, right? To raising capital for real estate deals. And so we saw it as a pretty natural progression of this regulatory change that opens up the internet as a distribution channel, essentially for folks that are seeking to raise capital and also investors that want to get into this asset class, for them to be able to access the deal flow that's, just massive deal flow compared to knowing one of their buddies at the country club, right? Or one of their friends in their social network. To be able to open up and connect both sides of that marketplace just seemed like a pretty fundamental shift in how those capital markets can function. And so figured if we can build a technology platform around it to make it efficient enough to match basically and provide a platform for both of those sides to match, you have to make it efficient, right? You have to give it that technological efficiency to be able to syndicate from 100, 200 or 1,000 different people in a particular deal. It's a lot of phone calls if you have to do that one-to-one. And so that was the genesis of it. And we quit our jobs and jumped in with both feet and 7 years later, $6.5 billion of real estate later, here we are.
Fantastic. So there's a lot to unpack there, and I don't want to go too far down the rabbit hole, but just generally speaking, the Jobs Act was so new. Everyone was trying to create their own interpretation of exactly what could or couldn't be done. So talk to me about some of the biggest roadblocks that you guys faced during those first couple of years of getting RealCrowd off the ground.
Yeah, first was just the regulatory understanding, right? Is this even possible? What does it mean to make a general solicitation, and what are the changes from how people have raised capital for decades, right? What do you need to do differently in this new environment to be able to take advantage of this regulation? So a lot of it was just kind of understanding how we can structure everything from a platform perspective. Again, what technology we need to build to bring that efficiency to the syndication process. But from an actual business perspective, it was marketplaces are very, very difficult companies to build because you're not just selling one thing, right? You're not just selling one side of a product. We have to have both investor capacity and deal capacity. So you have to have both sides pretty well balanced for it to be a successful marketplace, and you get the flywheel going, and it'll kind of feed on itself and grow from there. So that was one of the biggest challenges early on that I think a lot of companies faced was how do you spin up an investor base that can fund into a reasonable pool of assets, and how do you keep the sponsors happy with investors, and how do you keep the investors happy with new deals? So I think from a business perspective, I think that was one of the more challenging bits, and then understanding the regulatory framework that was again a radical change from what it had been for 80 years.
Yeah. I mean, so, just elaborating a little bit more on that, you were one of the first three real estate crowdfunding platforms to emerge into this new world. Mm-hmm. And so that market didn't exist prior, right? It was just really a hand-to-hand country club, friends of friends or pre-existing relationship, but there was none of this general solicitation. You couldn't go you couldn't go Google in, commercial real estate investments and find opportunities that you could passively invest in. So you also had the educational factor, right? You had to educate people, which is a very expensive process to go through, educate them and get them to trust this new way of doing things. And so you guys have obviously done a great job of it. There's been plenty that have come and gone over the years. Yeah. And you guys have obviously you put your flag into the ground, which is awesome. So kudos to you and the team.
Yeah, thank you. And education is something that we've always leaned really heavily into. I mean, we have our own podcast. We have a bunch of content. We have our own. It's RealCrowd University, and I'll plug if any listeners want to go to RealCrowdUniversity.com. It's a 6-week course of all the best of the stuff that we've put out from ebooks and content and blog posts and podcasts. So. Education is very core to what we do, certainly on the investor side. And our goal is to try to help people understand how to make sense of this asset class, right? When you give people access at this scale, we feel it's responsible to give them tools, to give investors tools so they can make better decisions, right? For a lot of people, this might be the first time they've ever been able to invest in a private real estate deal, right? So when you do that and you have this new access, what are those things you need to look at? What are the risks you need to consider? How do you look at one manager versus another? How do you figure out?
Hey guys, Kevin Bupp here, and I'm sorry for interrupting the show, but I have something super important that I wanted to share with you. Now, over the last few episodes, you've probably caught wind of me dropping hints on a little known about asset class that my team and I are very excited about, and that asset class is parking. More specifically, parking lots and parking garages in highly desirable markets. And just like we were ahead of the curve with mobile home parks, we feel that parking is one of the last asset classes where the mass consolidation has yet to occur. Anyway, we just wrapped up writing an ebook which goes into detail of the many reasons we are so bullish on parking investments and why you should consider this as a potential investment vehicle when seeking cash flowing real estate investments. Now, to grab your free copy of Parking Lot Profits, the top 10 reasons parking investments generate cash flow and legacy wealth, you can text the word parking lot to 31996. Again, text the word parking lot to 31996. All one word, no spaces, parking lot, all one word to 31996. And with that, let's get back to the show.
What the capital stack looks like. So taking people, and it runs the gamut from we've got, seasoned real estate investors, we've got finance people, we've got attorneys, we've got, your doctors, dentists, and we've got people that have never invested in real estate before. So how do we create almost a level playing field to get everybody on the same page as to how to review these opportunities. And education is a big piece of what we do.
Mm-hmm. So I want to back up. There's a point that I wanted to hit on when you guys were just starting the company, growing the company, right? It doesn't exist unless you have the two ingredients, right? You've got the deal flow. Mm-hmm. You've got the investors that are seeking to place their capital into deals, right?
Yep.
One without the other, it doesn't work. And so, yeah, exactly. So talk to me about how you guys, what were some of the strategies that you put into place way back when to ultimately build up that investor base while simultaneously creating deal flow, also paired with the whole educational factor, right? Like you have to educate everyone on this new way of doing things, but really bring those two together with the right timing.
Yeah, man.
That might be a lot to unpack. I don't know if that's a good question, but it's like, it's that old question for brand new sponsors getting into the space. I see this question asked all the time, like LinkedIn or Facebook. It's like, for those that have never gone out and raised capital for a deal, like what comes first, the deal or the equity? Which one? It's not which one comes first. Like you
kind of have to happen together, right? And we're still trying to figure it out. I'll tell you that. Coming from the real estate background, we know the business, right? We know the capital markets function. We know how real estate transactions come together. We know what that business looks like, and we had a lot of relationships in that world. Mm-hmm. So my co-founder and I, we came from the space, decades in the industry, so we had a lot of really good relationships that we could leverage early on for deal flow. So that was definitely the easier of the two sides for us. On the investor side, it was and remains anything and everything, right? There's no, and I think this is true also for sponsors, like you said, that are starting up. Platforms like ours can be a huge catalyst, but there is no silver bullet to how to find investors. Unfortunately, I wish there was. So for us, we were early enough in the space that there was a lot of press coverage. We went through an accelerator program called Y Combinator, which in the technology industry is a huge, social proof in the technology space is what it's called. So that allowed us to ride this early wave of press coverage and just awareness within the technology industry, which is very, very highly paid. Engineers in the Bay Area, right? We started the company in Palo Alto, so we were in that nexus of capital. This was a new, novel way to invest in things and give them a way to diversify out of their, 100% of their net worth being tied up in their startup or those few stocks. So I think we were fortunate to be early enough that we could spin up and leverage a lot of this wave around the industry for the investor base. And then it's been a lot of word of mouth, right? Through education and content and the podcast and people seeing really great results. They'll invest in a couple of deals, they're getting great cash flow, they're going to tell 3 or 4 of their friends. And I think that's still one of the most fundamental ways to grow a network, right? Is that word of mouth, that a friend telling you how good your experience has been with a company or an experience, that's infinitely more valuable than a Facebook ad, right? Infinitely more valuable than content. And so having those trusted referrals and that investor network is kind of growing upon itself. That's been crucial to the growth that we've seen for sure.
Yeah, fantastic. And so, just generally speaking, from the side of a vetted sponsor that has an offering on the RealCrowd platform, what percentage across? Well, I know it varies, but just looking for an average here, assuming that they're seeking equity, right? They're looking to do an equity raise. What percentage of that entire equity raise would you say comes from that RealCrowd network? And I know there's variables there, but if we look for a straight line average across all the different offerings you guys have had, approximately what percentage does your database or your platform help fill in, as far as the gap's concerned for the equity needs?
Yeah, so I can't give you a straight line average, but I'll give you a range of, usually it's somewhere between kind of 35 to 60% of the equity is going to come through our network. That's one of the things that we very early on took a position on was we don't want to be a capital of last resort, right? We don't want the deals that can't get funded elsewhere to come onto RealCrowd. Mm-hmm. And I think we've seen that, unfortunately, with some of the platforms that started early and no longer exist. They were just that. They were a source of capital of last resort, right? You couldn't get bank financing, so you went to a crowdfunding platform to raise a hard money loan. there's a reason hard money loans are what they are, right?
Sure.
And so we've always positioned that we want to be an augment for equity. We don't want to be a replacement necessarily. What that does is it ensures that the groups that we're working with already have an existing base of investors, right? They have the ability to capitalize these deals. This deal will close whether we're involved or not. And then this is a new way for them to meet a new pool of investors that they couldn't otherwise get in front of. And so, over time, we've done a handful of deals where it's been the bulk of the equity, maybe, 80, 85% of the equity. But that sweet spot, again, I would say somewhere in that maybe, 35 to 60%, somewhere in that range, 40 to 60%, is usually where we see the deals end up, because they've got their existing investors that still want to get in that deal as well. And so they're basically carving out a piece for these new investors to come in and start building those relationships.
That's a great point. So there's not like a proprietary relationship with those investors that come through your platform ultimately once they invest with one of the offerings on your website, right? Like, you're just acting as a conduit, you're pairing the two together. That once that relationship is formed, it's formed, right? Like, you're not acting as like a black wall between the two, correct?
No, and so there's three main business models in our space. We operate under a direct model, right? So again, we simply provide the technology for a real estate company and an investor to transact. That is what we feel that's the best way. It's the most efficient way. It's the most cost efficient way for both parties, right? We don't charge the investors anything, so it's completely fee free for the investors. You have a direct relationship with the manager. You have a direct security in the underlying investment, which we think is absolutely crucial. And this is still a relationship business, right? At the end of the day, we feel it's important for the individual investor to have a relationship directly with the manager. So that's a model that we've always operated under, and we feel is just the most efficient way to run this business. Other models are an aggregator model, which is where a crowdfunding platform will form an LLC for every deal. And as an investor, you're investing in crowdfunding company 72 LLC, which will then either originate a loan on a property or do a joint venture. So you don't actually own the underlying investment, right? You're investing in an LLC that crowdfunding company forms, charges a boatload of fees, and you don't ever have a relationship with the manager. And then the third model is what we would call like a proprietary platform, right? So if a sponsor themselves builds out their own crowdfunding platform just for their own internal deals, that's kind of the third model. Haven't seen a ton of that. Most are in that aggregator model. There's really only a couple of us that are operating under that direct model, but that's something that from the very beginning we felt is pretty crucial to have that direct relationship.
Yeah, no, I agree with that. And what does the typical fee structure look like for a sponsor that is posting an offering on your platform? Once they've been vetted and been approved by your team.
Yep. So we charge a flat fee to onboard the property, and then we'll charge a per investor processing fee. Average is somewhere around, I think we're somewhere around $1,200 per investor that we charge on a flat fee, whether that person invests $25,000 or $1 million. We just charge that one flat fee for processing. Blended, again, I'd have to look back across somewhere between 2.5%, I think is where we usually end up in terms of a cost of capital if you back into that, which is pretty much in line with what they would expect to pay or less than, if you go to a placement agent or a broker dealer. Far less than a broker
probably
dealer.
Less. Yes, absolutely. Probably about half.
Yeah.
Fantastic. So let's talk about the current landscape and what's that look like for RealCrowd? I mean, what type of shifts due to the COVID-19 pandemic? And again, this is so new. Day by day, we're seeing different changes occur across the country. Now we're at the point as we're recording this on April 21st. There's states that are already announcing their reopening. Georgia, I think, is going to be one of the first ones, and I forget what date they had said. I think it's this coming Friday that they're going to be basically opening the state back up and small businesses, what have you. And I'm sure there's going to be many states to follow there. And so again, we're still in the middle of the mess at this point in time. But I would love to get some feedback from you as to what kind of immediate impacts or changes have you seen present just with the inflow of investor interest, with new offerings coming in, offerings maybe getting pulled off the platform, investors putting brakes on, what have you.
Yeah.
What are some of those changes that have occurred?
Any and all.
Yeah, I'm sure.
It's been like you said, this is still so new, right? This is so fresh and so unknown that anybody's guess is as good as the next, unfortunately, right? It's a day by day thing. early on, we saw a number of deals that we were working on fail, that pulled out. Any buyer today is certainly not going to pay yesterday's price, let alone last week's price. Right. So we've seen a lot of deals try to go back and get some price adjustments, to varying willingness from the sellers. Right. If the seller doesn't have to recognize that loss, maybe they're just going to back out of the transaction.
Yeah.
So we saw a number of deals that just didn't complete. We've seen, loan quotes come in substantially higher rates, lower proceeds, higher reserve requirements, which will just blow up an IRR pretty quickly. We've seen other deals that, we've seen some development deals that are feeling great because you're already underwriting 18 months of no cash flow. How's it going to get worse?
Right. That's a good point. I've never thought of that.
so yeah, I mean, if you can, start moving dirt in next couple months and you're going to deliver sometime in late 21, there's probably a more certain look as to what 2021 looks like than there is, in Q4 of 2020. So it's been a pretty mixed bag, to be honest. On the investor side, anytime you have uncertainty, it's going to cause people to pause and kind of take stock of what's going on. So we've seen some slow, and then we've also heard investors that are, understanding that this is exactly why they like direct real estate, right? They don't like seeing their stock portfolio swing 5 to 10% on any given day in any given direction. To be able to pull that out and put it in an asset that's going to better stabilize and kind of smooth out that portfolio that's not valued on a daily basis. I think that's where we've seen not necessarily a contrarian view, but people that appreciate what direct real estate can do for a portfolio. They appreciate that even more right now.
Yeah.
So it's still really, really early though. I think it's going to be before we have our feet underneath us of what the new market is.
So RealCrowd is a company, though. I mean, at this point in time, assuming it's a vetted sponsor, you guys can get comfortable with the deal. That still might make it up. I mean, it would still make it up on the platform. You guys haven't ultimately put the brakes on new deals coming to the marketplace.
No, we've paused hospitality. We've put a pause on any new hospitality deals, right? I mean, that space has just been really impacted and unknown what the effect of that is long term, right? I think that's a lot of what we're trying to figure out now is what are the long term behavioral shifts from this experiment that we're all in of a shutdown, right? We've never gone through this before. We've never been told, don't go stimulate the economy, stay in your house, don't spend money, don't do anything. So it's been interesting it's been an interesting thought experiment to see, what are some of those longer term behavioral changes that are going to stick through this exercise. If it's a shorter term thing, like you said, of some states, which are, again, I don't necessarily agree with now is the right time to go back. I think until we get a handle on the health side of this, that's what we need to solve for before we move forward with anything, is really understand how far this is going to spread before we get too aggressive with opening things back up. Once we stabilize, then we can try to kind of rebuild from there. If it's a month, maybe this is a temporary thing and there's not a lot of behavioral shifts that really stick. If it's 2-3 months, maybe there's some things like we were talking before, right? Our office lease is up in the end of July. We were renegotiating a renewal. I don't know what our office needs are going to be in August, right? Yeah. So, is this the catalyst that makes remote working a normal thing? Could be, right? And then how does that affect the office space market? How does that affect the multifamily space market? Do people now want bigger units because they need a dedicated office in their apartment? So I think there's going to be a lot of unknowns around, again, what these longer term effects are, what really sticks, that I think will be interesting to watch and see how that will maybe affect our asset class and different property types within the real estate space.
I mean, speaking to some of these behavioral changes that might come out of it, I mean, the other three that come to mind outside of office is, retail, senior housing, and lodging. I mean, lodging, just we all know what that looks like at this point in time. Yep. I mean, it's absolutely a bloodbath. In fact, I've got a call with the CEO of Hotel Equities here today to discuss really what their plans are and ultimately how they intend to rebound from this, and what that painting looks like, right? What that roadmap looks like. I'm very interested in that conversation. And same with senior housing. Senior housing, you would think that obviously people are still getting old, right, and they're still going to need assistance. However, senior housing in its current form, in a group format, is that conducive to I mean, is that conducive to a future pandemic or a resurgence of this come the fall of next year, right? And what does that shift potentially look like? Retail, I mean, again, retail, another bloodbath. I mean, just especially when you start looking at the big movement that's happening. I think Cheesecake Factory was the very first one that kind of made the announcement about 3 weeks ago that
hey, we're just not going to pay rent.
Yeah, right. And
not to pay
you get
rent.
that big behemoth like that makes that comment. Right. Guess who's following suit? Everyone, right? Yeah. And ultimately, how's that play out in the long term? Yeah. Especially if there's no, government support that comes in for those folks that own that real estate. And it's just
and that's so 2 points to that. I think I just think of all the little smaller restaurants and retail spaces in a 10-15 minute walk from our office downtown Portland, right? How many of those can survive a shutdown of X number of months and have the capital to spin back up a whole new fresh inventory to be able to open back up, right? That's a pretty expensive endeavor to basically start up a whole new restaurant or
basically starting over again. I mean, because you just assume that you're going to get half your work staff back, right? Because the other ones probably maybe they went somewhere else, right? So you got to retrain a whole new staff. Even those that worked there prior, if they've been gone for 2 or 3 months, you pretty much have to retrain them again, right? And this is making the assumption that once we turn the switch back on, that restaurant's going to be filled up again on Thursday, Friday, and Saturday nights, the prime nights. More than likely, that's not going to be the case.
It's not going to happen right away. No, certainly not right away. Right, it's going to be some time if it gets back to that. And I mean, again, as humans, naturally, we have short memories. I'm sure we will forget a lot of this pain that we're going through right now from just kind of this mental state that we're in, and those old patterns will emerge, right? But what you also touched on there is this. This notion that landlords need to just suck it up and they need to be the ones that shoulder all the burden of people not paying rent, right? Landlords have a business to run too, right? If tenants aren't paying rent, they still have to pay the water bill, they still have to pay the electricity bill, they still have to pay for security, they still have to pay all their building, they have to pay their taxes, right? So I think it'll be interesting to see if something comes out of the stimulus package to address landlords, right? I think it's great if there's packages that come and provide rent relief for tenants, residential tenants, for multifamily tenants, for retail or office tenants. I think that's wonderful. We need that right now. But I don't know that that's necessarily prudent to stick that whole responsibility back on the landlords, because their mortgages still due, right? Their utilities still have to be paid. So there are still operating expenses that building owners, I think to date, most of the conversation has kind of neglected what that impact is to the real estate owner and how that will affect their operations. So I think that'll be, again, interesting to see if future stimulus packages do something to address that, how that changes, right? And if there's a way to mitigate the kind of upstream effect of a tenant not paying rent. That doesn't just stop at the tenant paying rent, right? That can impact operations, that can impact mortgage covenants and all that going up the chain.
I'm actually surprised it hasn't been addressed at this point. So we're in the housing space. We own manufactured housing in 13 different states, and even then, being on the residential side of things, there was a lot of media conjecture that has been misinterpreted greatly over the last couple of weeks regarding the moratoriums on evictions and how that's interpreted by different tenants living in residential housing units of do I should I be required to pay rent? I'm not paying rent. They can't evict me. I'm staying here. Let's gather together. Let's rejoice and fight against the mean landlord together. And that message has played out. I've got a lot of other folks that I know in the multifamily and the manufactured housing space across the country, and some are doing better than others. But I can tell you that our collections are down. I mean, and not just the matter of being down, but really down, but also those folks have basically played radio silence. I mean, after multiple attempts, every attempt possible to offer a workout plan, to truly offer some type of financial assistance, they're basically just ignoring the communication lines of communication, and what that tells me is that there's a there's a misinformed aspect of it that has ultimately become as a direct result of the media and how they're covering this thing. And also ultimately that trickles down to those owners of those properties, the same as it does with the retail tenants and the office tenants. They don't pay their rent. It trickles down to the owner of that property. And it's a catastrophe no matter how you look at it, right? It's a catastrophe for the folks that can't pay their rent. And it's a catastrophe for the folks that can't pay their mortgages and tax and insurance associated with the building, right? No one wins unless there's support on all sides. So,
right. And
again, I'm surprised it hasn't actually been addressed at this point. It's been spoken about, but it really no solutions as of yet.
Yeah, I think to me, this should be a unifier, right? This is not a thing that cares about political lines. It doesn't care about socioeconomic status. It doesn't care about geography, right? This is literally humanity against this thing. We all need to find compromises. We all need to come together and try to find a solution that gets us as a species, right, through this. This is humanity against this virus. This isn't
a team effort, man.
Right? We all need to kind of come together, and there's a ton of changes, right? I mean, look, I'm in my house right now, recording this podcast with my 3 kids that my wife is, a saint giving them.
Mine too,
right? It's just it is an unfathomable amount of change that we're all going through right now collectively, and so my hope is that there's some way to find a unifying thread through this and understand that we're all in this experiment together. We all need to find a way to kind of band together and make sure we can all get through this, because it's the potential for this to even further divide, is certainly there. And I'm hoping that's not the direction that it goes.
Yeah, no, I agree with you. And again, being respectful of your time here, there's one last question that I want to hit on here before we roll on to the wrapping up the show. And, your RealCrowd's got a kind of a rating system based on risk, your assessment of risk of a particular offering, and there's 3 different tiers. At least you correct me if I'm wrong. It's opportunistic, which is the highest, perceived to be highest risk; value add, which is kind of in the middle of the road; medium risk; and then core plus, which is the lowest risk. Are there any other ratings, or is that it? It's those 3 tiers.
Yeah. Correct? So if you go on the homepage, there's a chart about halfway down the homepage. It actually has there's 4 core plus, value add, and opportunistic. Those are kind of the 4 main food groups. And again, we have a nice chart on there that shows you the expectation of how much cash flow is coming as a part of return and leverage loan to value amounts. But those are actually picked by the sponsor that classify into those 4 different categories.
Got it. So obviously, over the last, the last market run up that we, just experienced over the last 8 years or so, people have been very bullish, right? I mean, more inclined to chase return and going after those value add or opportunistic type of investments. And so, what if you had the crystal ball and it was actually working, right? And what do you think that crystal ball? What do you think moving forward? Again, this is assuming that we find some type of new normal over the next, let's say, 3 months, with, that transition period, Q3 and Q4 this year, where we're actually starting to really get back to some type of normal society. What do you think moving forward? Let's say 2021. Do you think there will be a major shift with investors as far as, chase returns or chase, less risky investments, the core and core plus? Investments.
Yeah. So this is something we spend a lot of time thinking about, and we're actually in the process of launching our own RIA platform, our own registered investment advisor. It's called RealCrowd. So we've got a website spun up, realcrowd.com, and the premise behind that was exactly what you're talking about, right? There was no way historically to try to quantify and understand the risk inherent in real estate investments. Right. It was, a core plus deal is we'll buy something at 85% occupancy, spend 20 grand a door. We'll get a 13, 14% target IRR. So we'll call it core plus, right? That's about as scientific as it was. And so what we saw the behavior occurring on our marketplace and on other platforms around was exactly that. It was chasing returns, right? It was target IRR was it was the only metric that really mattered, without any real understanding or appreciation for the risk that people are taking to get to that return. And so we've spent the last probably 18 months now building out a risk underwriting and scoring methodology that looks at risk across 5 categories. So it's the market, the manager, the physical asset itself, how the deal is capitalized, and the partnership structure. And within those 5 categories, we look at about 200 different subcategories and come up with a actual quantified ranking on where it falls from that core to opportunistic spectrum. So we're doing a lot of work on understanding risk and trying to communicate that quantifiable risk to investors so they can build a portfolio that's right for their scenario. That's not just, there are deals that should just patently not be done, right? There are just some bad deals out there. But other deals might be better for you than they are for me, depending on your goals and kind of your investment horizon and your personal investment philosophy. And so that's what we're hoping to take is a way to build a real estate portfolio that's really based around risk and make sure that you can sleep at night because you're taking on the right amount of risk for your investment portfolio. So that's something that we're working on right now. You can check it out at reallocate.com. Some pretty good information about it. But in terms of the just the raw strategy towards real estate deals, I genuinely believe, again, and I hate to give this answer, I think we're still too soon. I think we're too soon to tell, right? What's different about this, and again, it's always different, right? You can say every cycle it's different, but this time it's different. This isn't a real estate driven crisis like we saw back in 08, 09. This is a very acute external threat that's causing this crash and market disruption. So real estate entered the space in a pretty good environment, right? Historically low vacancy rates, historically high rent growth, very well capitalized from a debt perspective, much more conservative leverage against assets across real estate in total than it was going in the last crisis. So real estate entered into this in a really healthy position. I think what's the unknown is again, at what point does this become a real estate problem, right? How long of a duration with this shutdown and with this pause on economic activity? I think that duration is going to largely determine how much of an impact real estate feels. And if it's shorter and we can kind of, real estate moves slowly enough valuation wise that we can maybe skip the bottom part of that V if it's more V-shaped or swoosh shaped, maybe the impact won't be as great and we can kind of get back to business as usual. And then we're just in a normal recessionary environment, right? We're not going to see that rent growth that we saw. Maybe we're going to see, maybe a dip in rents. Maybe we'll see flat rents, right? I don't know many people that are going to be underwriting 2, 3, 4% rent growth anymore.
Yeah.
So, a normal recessionary environment we can operate in. It's this unknown of this artificial shutdown that we have a hard time trying to forecast for. So the sooner we can get back to just a normal cycle. I don't anticipate this to change the basic business model of real estate investing all that much coming out of it.
Mm-hmm. Yeah. And again, back to the behavioral shifts that we just don't know how exactly they're going to play out. Obviously, they'll impact some sectors much harder than others. Again, specifically speaking to lodging, retail, potentially office, potentially senior housing, what have you. And only time will tell. But no, I agree with all your other points. So I appreciate that feedback. I know we don't have a crystal ball here, and literally it's just all opinions at this point in time.
And you turn the table. I'm usually on the other side of the microphone. I'm asking people for crystal ball, so I'm in the hot seat.
The interesting thing, I actually saw a sponsor who I'm very familiar with. I won't name a name. He's a good guy. He's in the multifamily space, and I saw him come out with an offering recently. I thought it was ingenious. He's actually spinning it as a pandemic proof, or maybe it wasn't pandemic proof, but basically he's spinning it off of the pandemic, and essentially it's a multifamily development project that doesn't have common space amenities, but he spun it as a positive. No area to congregate near a pool or a clubhouse. No wasted amenities that ultimately would offer a place for folks to gather, right? And that's a positive. Normally it would be
probably help the development budget, but I don't know if that's going to be a long-term great idea.
So, an A for effort, though, right?
Yep.
Well, fantastic, Adam. So we're going to move into the what we call the lightning round here, and this is where I just ask 6 short, somewhat personal questions, but just looking for 6 short answers here, so we get to know you a little bit more intimately. The first one: your biggest fear. What is it?
Unknown. Right. I mean, I think it's I think we're all in it. This is a really interesting time space for all of us to try to figure out what that new normal is, and I think we're all in it together. So just one day at a time. Yep.
How about one biggest regret?
Biggest regret: not getting started in real estate sooner. I think the sooner you get started, the better. It's a wonderful asset class. We love it. I wish I would have got started even earlier.
Agreed. How about most influential book or business book, either way, book in general?
Business book is probably The E-Myth by Michael Gerber.
Oh, that's a good
That
one.
is a fantastic book. Non-business book is Golf is Not a Game of Perfect. I used to be a golf pro before I got in real estate years ago, and that was one of those transformative books for me.
Okay. How about outside of the daily work grind? What do you do to decompress?
Well, again, those that are watching, you see that river behind me. I'm a fly fisherman, so that's why we're up here in Oregon. Lots of great rivers around us.
How about the one thing that you can't live without?
My family.
All right, good one.
Yep.
And last one here. If you woke up tomorrow, just decided for whatever reason that you just really had no interest in being in the real estate space any longer, RealCrowd or not, but just generally speaking, you wanted to make a major life change, career shift, where would you find yourself spending your time?
On that river right behind me.
Fantastic. I like that. That's good. Good. Maybe you being a guide, right? Or just out there enjoying the nature yourself. Yeah. Good stuff. Well, Adam, this has been a lot of fun. I really appreciate you coming on here, man. It's been very enlightening, and wishing you and your team the best as we and your family, as we push through these uncertain times. And would love to maybe have you back on, 4 or 5 months from now, and actually kind of gap and see how on or off we were with kind of our assumptions of what the future might hold for us. But in any event, I hope it's all great, and we'll all make it through this thing. And very much looking forward to what that new normal looks like.
Us as well. Thank you so much for having us on. And again, we wish you and your family all the best of health, and all the listeners out there. And again, we'll get through this. We're not sure what it looks like yet, but we will get through it one day at a time.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.